Oh, awesome.
Good morning, everyone. We are here again today, live with Paige Zecker. She is going to go over exactly what we need to know about our credit score, what builds it up, what helps it, what doesn't help it. So, without further ado, Paige, take it away.
Thank you very much. I'm excited to be back with you guys as always, and just wanted to share some things about credit that you may or may not already know. So let's just dive in. Let me share my screen real quick. So I'm gonna share 5 things that you may not know about your credit, but you need to. So why do you need to really know about your credit? Because it affects so many different areas of our lives, whether that be insurance premiums or based on your credit score. For people that rent, your potential landlord's going to be pulling your credit. It could affect whether or not whether your rental application is accepted. It could also affect how much rent you're paying. It affects your utilities. Utility companies are also pulling credit. And it can affect whether or not you get a loan, regardless if that loan is for a car, personal loan, getting a mortgage. It also affects the interest rate that you pay. And we'll take a look at that at the very end. So what's the first tip? First thing that I want to share with you, how many different scoring models are there?
Around 5.
Are we talking just mortgages? Or are we talking like
At any,
I'm gonna say 15 different ways?
Eric says,
there's really 2 main scoring models. There's Vantage Score, but within Vantage, there's 4 different types of Vantage scores. And then there's FICO. FICO is what's used for getting a mortgage. But within the FICO score, there are 49 different types of FICO scores. Let's take a look at what makes up each. Factors that are going to make up the Vantage Score. Well, first of all, let me back up. Vantage Score was created by all 3 of the credit reporting bureaus, Experian, TransUnion, and Equifax, and it was designed to be a tool for the consumer to be able to monitor their credit. It was not ever intended to be used for companies extending credit. Some of the things that make up the Vantage score is 40% of that score is based on your payment history. 21% is the age and the type of your credit. And then the percentage of that credit used, the total balances, recent credit behavior, and the available credit. The FICO score, you'll see how there's different things that make up that score. There's different things that are important on one versus the other. For the FICO score, the thing that makes the biggest difference with the FICO score is the payment history, followed by the amount that you owe or the credit utilization, followed by the length of that credit history, and then tied for the next 2 is the credit mix and then new credit. When you look at them side by side, you can see how the different weight is given to different areas that make up that credit score. So that's why your Vantage score is going to be different than your FICO score. And, so many times I'll have people call me and go, Credit Karma says my score is this. Well, Credit Karma and the other credit monitoring services that are out there are looking at the Vantage score. They are not necessarily looking at your FICO score. Talked with a lady last weekend that she said after I pulled their credit, the 3 bureaus reported one score, or they each had reported a score, of course, but the scores that the credit bureaus reported when I pulled her credit did not match. She had the My FICO app and it didn't match. And it's because you've got the different algorithms even within the FICO scoring model. So 2, soft credit pull or hard credit pull.
I have, excuse me, I have a question about that backing up. So, because everybody is watching their credit so hard, and they think that, okay, because I've looked at my FICO score and it says that I'm at a 620 or a 520. Let's go 520. I can't get a loan. Do we find that what they're looking at is typically true? Or is it better than what these scores are saying? Or is it worse than what these scores are saying?
That's a great question. And I'm really glad that you asked that. So this will tie into something that we'll wrap this presentation up with. Okay. So when a mortgage lender pulls your credit, we're going to pull all 3. We're going to do what's called a tri-merge. Let me unshare for a second. So we're going to do a tri-merge credit pull. And we're going to look at the total credit report. But as far as that qualifying credit score, we're going to use the middle score. So toss out the high, toss out the low, and we're going to use that middle score. The credit monitoring apps, like Experian has a really good one. They've got their own, and they tell you that it's your FICO score. They're going to only show you 2 of your credit scores. They're not showing you all 3. So oftentimes when I talk to people, they'll go, oh, but my credit app shows that my FICO score is this. But you don't know whether it is the high, the low, or the middle. So many times when I talk to people, they're telling me, oh, my FICO score, my credit scoring app says my credit is 659, when that's really their high score. And that high one's not the one that we're going to use. Sometimes people will look at their Vantage score on the My Credit Karma app. Most times that is a higher credit score than that middle FICO score, but not always. And I have seen the range be, 100 points difference. And I've seen it be just 2 or 3 points different. It's always different, and it's not necessarily higher or lower. It's just going to be different. Does that help?
Yes. But if somebody's coming in looking at their score and they've got, for whatever reason, maybe a 498, there's almost no reason to have them get in touch with you thinking that they would qualify, but yet get them in touch with you so you can put them in touch with somebody and give them education to improve their score.
It's always good to, regardless of the score that somebody thinks that they have, one, because they don't know the score that they think they have, they don't know whether that is the middle score that a mortgage lender is going to use. So until we pull their credit, we don't know what that qualifying score is. So maybe they think they've got a 520. Maybe the 520 is the low. If that's the low, then that middle score may be high enough that it makes sense for them, that they qualify. And we can do loans with his credit score as low as 500. Is that the best thing for the client? Maybe, maybe not. And there are other qualifiers that go along with that. But it is always a good idea for somebody to go ahead and talk to a lender, because we can look at the complete credit report. The credit score it's just that. And it doesn't tell us what has made up the score. That's where the credit report, and we get into what's on the credit report. So we'll kind of dive into that a little bit more here in just a minute. So let me share my screen again. Okay. So here you can just see the two different, the Vantage score and the FICO score side by side, and what makes up those scores is different. So there's different importance put on different aspects of the credit score. So my second thing for you is soft pull versus a hard credit pull. So kind of the 411 on one versus the other. A soft credit pull is, again, that is usually what you were seeing when you're doing the personal credit monitoring. It is not used for lending purposes. A soft credit pull, many people believe that, a soft credit pull is going to be better because it doesn't ding your credit score from having that pulled. One of the misnomers about having a hard credit pull is when you apply for a mortgage, and this is usually the number one objection that I have from people when I start talking to somebody that wants to get pre-approved for a mortgage. They're like, "Oh, but do you have to pull credit? Because I don't want my credit to be lowered when you pull it." A hard credit pull, when you are applying for a mortgage, any guess how many points it's going to ding your credit? It's going to be between 1 and 4 points. And reason for that, but if you go to Lowe's and get your credit pulled for a credit card, then you go to Kohl's and they pull your credit to save the 20% by applying for their credit card, and then you go shop for a car at this dealership and you go to a different dealership and you've got all those other credit pulls, those are going to hurt your credit. Versus the credit agencies know that if you are getting a mortgage, that is for a home and that is an asset. That is going to help your finances. Yes, there's a monthly payment that goes with that, but it is building wealth. That is a good thing. So they don't want to ding your credit. And also, they know that you're likely to shop different lenders. So if you have several different lenders pull your credit and do that hard credit pull, only the first one counts. Within those like a 30 to 45 day window, only that first credit pull is going to ding your credit. All the subsequent ones don't. And also, I always tell people, if 1 to 4 points is going to make that big of a difference in whether or not you qualify for a loan, we probably need to be having a different conversation. And that's where we get into helping people improve their credit. So the third thing, what type of account impacts your score the most? Any guesses?
Can I guess revolving credit? Like the
Yes.
for credit, because like you have $100,000, you have $50,000 at a Target.
Yeah, great guess. And you are correct. It is credit cards, which are going to be your revolving credit. The reason they have the heaviest impact on your credit score is because they're factored into your credit score twice. It is the only type of credit account that affects your credit score in two different ways, and that is your payment history and your credit utilization. So because they have the biggest impact on your credit score, it's the fastest way to drop your score, but they can also mean it's the quickest way to improve your credit score. Some of the right ways to max out your credit cards would be having open credit cards that report positive, low balances, and on-time payments is going to gain you some positive credit score points. Not paying off the complete balance every month is also going to help so many people. I talk to so many people go, oh, I have just paid off this credit card, or I pay off my credit card every single month. When you do that and the credit reporting agencies are reporting a zero balance on that credit card, it looks like it's inactive and you are not gaining any positive points by that. The best thing that you can do is to maintain just a little bitty teeny tiny balance, even $5 to $10. And then lowering your balances when you apply for a credit card is going to give you the highest score possible when your credit is pulled. Also, kind of the magic number with credit cards is to keep that your credit utilization between 10 and 30% of your available credit. So if you've got $1,000 credit limit, don't put more than $300 on there without, you don't want to go up above that. Keep it paid down between that 10 and 30 is going to help you the most. And this can affect your credit score very positively, very fast by changing that credit utilization. I saw this just recently where a client, we saw about an 80-point improvement in their credit score in less than 2 weeks. And it had to do with them paying their credit balances off. One of the things that will impact your credit score very negatively, and I jokingly talk to people and go, okay, we want to practice saying no. When you go to Lowe's and you're looking at those appliances for your new house, and they go, would you like to put this on your Lowe's card today and save 20%? No, you do not. One, you don't want to run up your charge card. And two, or if you already have one, and then two, you don't want to be opening new credit. Same with Lowe's. Oh my goodness, I had a client. We were just before closing, and mortgage companies we're monitoring your credit. We're looking for new inquiries. We're looking for all of a sudden you've got a new balance. So we are monitoring your credit between the time you make an application to the time we close. So we get an alert every time there's a significant change on your credit. And we were like days before closing, and all of a sudden we get an alert. This client had just opened a Kohl's account and had charged $1,000 on a Kohl's account. Fortunately, we still closed. They paid the card off, and we were able to show the paper trail. They were going on a really nice vacation after they closed, and they went and bought a bunch of luggage. And of course, they were buying over $1,000 worth of luggage and clothes for their trip, so they wanted to save that 20%. And one of the reasons why store cards in particular can have the worst impact on your credit score is because of that credit utilization. Oftentimes, the credit limit on those at the cash register credit applications, your credit limits are going to be very small. They're typically between $300 and $500. Maybe if you've had the account for a while, you've got a higher credit limit. But those new accounts, maybe you are buying $300 at Lowe's and you open a card and they give you a $500 limit. Well, now you're up above that 30% credit utilization. And that is typically the case for these retail accounts where you have such a small limit, even though you have small balances on them, that credit utilization is above that 30% and it has a negative impact on your score. Any questions?
Yes, I have a question. So what happens if you have a bunch of credit cards, no balance? Would it be better to actually shut those credit cards down or just do a $10 charge and let that $10 charge pay, like you say?
But we have to also think, what if you have above 800 credit score and no balances? We're talking people that have lower credit scores, right? That it's hurting their credit. Or if you have above 800 credit score, is it hurting my credit that I have 10 cards with no balances on them?
It's just not helping. No, it's not hurting you. It's just not giving you that positive credit history. So if you've got a card out there and it has a zero balance, it's not hurting you. It's just not helping you build that positive credit.
But if you've got that 800 score, it's not a big concern.
Right.
Does it hurt to shut them down?
It does. It does. And that's going to tie into this next thing. So the fifth thing, what are the most common credit mistakes that prospective home buyers make? Paying off collection accounts or charge-offs, closing out credit cards, because when you close out any kind of credit account, it can lower your score. And I'll give you, for instance, my dad had a second home and he decided to sell it. He had a mortgage on it and paid it off. He had like 800 credit score, paid off the mortgage, which you would think that would be a good thing, dropped his credit score 100 points. He was shocked. It comes back really quick, but anytime you pay off or close out a credit account, it does negatively impact your score, at least in the short term. So when you're applying for a mortgage, the assumption is you're going to want that loan approval fairly quick so that you don't want to have that negative impact and then have to wait for it to come back. Opening new credit cards or new credit accounts. We kind of touched on that before with where you go into the retail stores and they always tease you with, do you want to save 20% on your purchase today by opening a TJ Maxx card? No, I do not. I would love to save the 20%, but my $4 purchase, I think I'll refrain from getting a new credit card. But I see this a lot. And then increasing balances on your credit cards. So getting back to the Lowe's, maybe you already have a Lowe's account and we're just before closing and you know you're going to need a refrigerator. So you go to Lowe's, they've got refrigerators on sale, you find the one that you want and you put that on your charge card so you can save the money. Well, we're going to rerun credit or may rerun credit just before closing. If you do, you want those scores to be as high as possible. So you don't want to do anything while you're in the process of getting a loan that could dramatically change your credit score, and increasing the balances owed will do that.
Daniel had a question. I don't know if you've seen it pop up on chat, but
I did not. I can't see chat.
Okay. How long did you say it takes to report?
It depends
On?
the credit bureaus, and we can do something called a rapid rescore, where we are kind of forcing the credit bureaus to go ahead and report something. So it could be, depends on what it is that you've paid off. It could be something that reports very quickly, and it could be something that it needs to cycle because every credit reporting bureau has a different cycle time. So that's really why it's going to be something that depends. If we're doing the rapid rescore, where we're being very strategic about having somebody pay something off, or maybe one of the actual kind of interesting little tips that I had learned from my credit restoration specialist is sometimes raise that credit utilization. Sometimes the least expensive way to do that is calling your credit card company and asking for them to raise your credit limit. And that doesn't cost you anything, but it may be just enough to get that credit limit, that credit utilization up above the 30% without even having to pay anything off.
Okay. Here's another question.
Go ahead.
Does a car loan, like a 20-year mortgage, hurt you more or less than a car or a mortgage?
Well, if you go back to the different things that impact that credit score, the type of loan does play, or the type of credit plays into that somewhat. It really has more to do with that payment history. And then when it comes to how it affects getting a mortgage, obviously if you already have a home and you're buying another home and you're selling that departure residence, that monthly payment that's factoring into your debt to income ratio, that current monthly payment's going away versus the car loan is not. So it does, those types of things don't have as big of an impact on your credit or your credit score as like the credit cards do, just because the car loan and the mortgage loan are only impacting your credit based on that monthly payment history, or the biggest impact is the monthly payment history. Any other questions?
That's it.
All right. 2 big don'ts. Don't pay off debts without talking to your loan officer. This ties into what we were just talking about. I have had folks that go, you know what, I can't quite find that house that I'm looking for. In the meantime, I want to boost my credit so that I improve that interest rate that I'm able to get. And they use their down payment money to pay off their debt. So many people don't realize that one, paying off debt has the immediate impact is that it's a negative effect on your credit score. So one, if you're trying to get a loan, I always tell people that as soon as they give just this little hint that, oh, well, I'm going to pay off some of my debt, let's take a look at what you owe. Sometimes paying that off may or may not have a positive impact. And if so, if paying off debt does make sense, one, are you going to have enough money to pay off that debt and still purchase the house? Because if you're using your down payment money to pay off debt, now you might have improved your debt load, but you got no money to buy the house. And I've had several people that have done that. And also, we are looking at all the list of debts on your credit report and that minimum monthly payment. And that's what makes up the debt to income ratio. So working with your lender, anybody that's wanting to pay off debt, in order to improve the likelihood that they are going to get a mortgage, it is best to talk with a lender first so we can strategize on which of your debts is going to have the biggest impact, positive impact on your credit score and or the debt to income ratio. We actually have tools that are provided to us by the agency that we use for pulling credit. We've got a couple really phenomenal tools that we can use to help people be very strategic in paying off that debt. Any questions?
I like strategic.
Yeah, that's our word right now, isn't it?
It is. We should also touch on deposits and withdrawals, because that confuses a lot of people as well, of the fact that if you've got a bunch of money under your mattress, you want that in the bank before you start your loan process.
Yes, that's a whole different conversation because that does not affect your credit score. So
Right.
that would be good for a whole nother talk. But I do have a bonus for you real quick. So what credit score do you think you need to get the best mortgage interest rate?
720.
Daniel says 720. I say 680.
Both great guesses. This is, and if y'all are sitting in front of your computer and you want to type in, go Google and type in Fannie Mae LLPA, that stands for Loan Level Price Adjustments. This right here is what Fannie Mae says is the credit score to loan to value price bracket. So anything above a 740 is going to get you the highest credit score, but it's a combination of credit score and down payment. So you can have an 800 credit score and putting 3% down. So you see this top level right here, putting only minimum down payment, you're going to pay a little bit of a premium or have a little bit of a hit to your credit score to get not your credit score, your interest rate. To get the lowest interest rate possible, you need to have a 740 credit score or better and be putting 40% down. So all the folks that go, oh, I've got an 820 credit score and I'm putting 20% down. Okay, you are still going to pay a little bit of a premium for that interest rate. That combination does not get you the lowest interest rate. So I found this to be very interesting that your credit score this was lower than what I thought you would have needed. I would have said before I got into lending, I would have said you needed an 800 credit score to get the best interest rate, but it's really a 740. And then this goes down to 620 just because Fannie Mae is predominantly your conventional lending. We can go down as low as a 500 on an FHA. Typically it's 580, but you are going to see different price brackets with FHA and Freddie Mac as well. But you can see where you've got your price brackets. So like somebody that were to come to me and they would be, here in the 600s, and maybe they're at the 639, by improving their credit score just a little bit makes a difference in their interest rate. And right now that's really, really important with the high rates that we're seeing. It is next to impossible right now with the interest rate environment to get a par rate. So it may be that the rate that you pay doesn't change because of your credit score, but maybe the cost to get that rate. So this is how all of your credit ties into the mortgages. Is this helpful?
Absolutely.
So to improve our credit score, we won't want to pay off the credit cards, just to pay them down and keep it low.
Correct.
It's the same with auto loans and stuff like that.
Your auto loans, paying those down does not impact your credit score because it's not being considered for credit utilization. So just because when you get a car loan, maybe you start out, it's a $20,000 car loan. If you pay that down to a certain level, you're not going to go back and charge that up again. It's that revolving credit where credit utilization is important. That does not factor in when you've got an installment loan. Paying it on time is what's going to help you or hurt you when it comes to the installment loans.
So
Here's another thing that does tie into car loans. Any kind of installment loan, when we pull credit, it does show what was the maximum credit limit, how long you've had that credit, what your payment history has been on it. But it also shows how many months until that debt is paid off. Anything that is less than 10 months till it's paid off does not count in your debt to income ratio.
Okay. Would it help to pay off the car loan faster, or not at all?
Because it's not the installment loans, it's what's your payment history like. It's not helping you from a credit standpoint to pay more on that loan. It's not helping you to pay it faster because all we're seeing is, did you pay it on time? Or the only thing that the credit bureaus are reporting is, did you pay it on time as agreed?
So it'd be better to have the payment history than to pay it off.
Yeah, from a credit score standpoint. And then if you're looking at getting a loan, you don't want to pay that off just before you get a mortgage because it is going to have that negative impact on the short term.
Does it affect your credit more if you have like different investment accounts and plans to say that you have the ability to go out and tap into an investment plan? Like let's say everybody thinks about a 401k. Is that good or bad? Is it treated the same way as looking at a $100,000 credit card?
Investment accounts don't show up on your credit report. Bank accounts and how much money you make or how much money you have sitting in an asset account, your 401k, an IRA, an investment account, your depository bank accounts, so your checking, savings, all that, none of that factors into your credit score. So to answer your question, if you've got an investment account that you've got $100,000 sitting in that account versus having a home equity line is going to show up on your credit report. Or if you've got a credit card with a balance on it, So
Yeah.
those things, those will affect your credit.
If you have a HELOC and you don't have any money on it, I mean, you have no debt, right? It still affects your credit.
It does.
Okay.
And this is a real misnomer. It also impacts your debt to income ratio if you go and get a mortgage, because we see that HELOC sitting on your credit report. The debt to income ratio, or the monthly payment that gets factored into that debt to income ratio, even if you have a zero balance, is what would the minimum payment be if you maxed that HELOC out. And that counts against your debt to income ratio if you are planning on keeping that once you get a loan.
So, I mean, if I could go and get 100 grand out of an investment account and I have to pay, say, 4% interest on it, that doesn't show up as the same way as like a HELOC.
An investment account doesn't show up on your credit score. That's not a debt.
If it's a debt, if I go borrow 100 grand against it, right?
Like a 401k, that is the 401k lending you the money. You're borrowing that from that investment account. That's not a debt that gets reported to a credit reporting bureau.
Well, I learned something new. Thank you.
Other thing I have to think about, the question about the HELOCs having a zero balance. One of the other things that I see very commonly, or actually two things I see very commonly that impact people's debt to income ratios that show up on a credit report that affect debt to income ratio that people discount, is deferred student loans. A deferred student loan, while you may not be making a monthly payment on it, when we go to calculate the debt to income ratio, we see what that balance of that credit card, or not credit card, excuse me, the student loan, we see what the balance is. And depending on the type of loan, Fannie Mae says that you use 1% of that balance. So if you've got a $5,000 balance, we're going to count $50, whether you're making a payment or not. We're going to calculate a $50 monthly payment in your debt to income ratio.
Okay.
And if you're getting a Freddie Mac backed loan or FHA, USDA, something one of the government loans, we count 50% or like a 0.5%.
And that changed recently, right?
Yeah, that changed. It dropped to a 0.5% like within the last year and a half. It used to be 1% across the board.
Which if you owe $15,000 or $20,000, that's a big deal.
I see people more frequently than I ever expected that are making $30,000, $40,000 a year that have in excess of $100,000 in student loan debt. They're like, oh, but it's deferred. Well, you've got $100,000 student loan debt. We're going to have to count $1,000 a month towards your debt to income ratio, and you're only making $3,000 a year. Can't get a house with that. Even if we go FHA, you've got $100,000 in student loan debt, and we're counting a 0.5%. That's still a $500 a month payment. And if you aren't making the income to offset that, I have seen that prevent people from getting loans. But the other thing that doesn't count, I just had a conversation with somebody over the weekend. He had gotten some bad information from another loan officer. One of the things that does not count against you, it factors into your credit score, but it doesn't count towards your debt to income ratio or any derogatory credit, is medical. If you've got any kind of medical collections, and this was actually a recent change that took place in July with how medical collections are actually getting reported. And many things of those medical collections that were already reported to the credit bureau are coming off of people's credit scores. They no longer can report medical collections to the credit bureaus. And that has had a huge impact on people's credit scores, even though it doesn't count like on collections. Sometimes you can have a collection account or a derogatory account where you still are making a monthly payment or there's a balance there. Like FHA, you cannot have collection accounts with a total balance in excess of $1,000 and get an FHA loan. If you do, you have to have a payment arrangement. And then like Fannie Mae says, if you've got over a certain amount of collection accounts, you've got to count 5% of whatever that balance is into the debt to income ratio. So medical collections don't count into that. And I just had to talk to somebody over the weekend, and he was short on funds, and we were talking about ways he can come up with some additional funds for down payment, but also some things. His credit score was right at the cusp. He was like 1 point shy. If he'd gotten it just over the 600 credit score line, would have made a huge difference in rate for him. And as the rates come down, it improves the debt to income ratio and allows him to buy more. So it was such an impact that one credit score point was going to make. We were looking at things that he could pay off, and he goes, well, I just paid off. We were looking at things that were on his still reporting. And he goes, well, that medical collection, I had talked to another lender, they said pay off that medical collection debt. So I've just paid that off. And I'm like, oh, I wish I had talked to you before, because somebody gave you some really bad information that wasn't counting. It counts in the score, but that was not the debt to pay off.
And a lot of people automatically think that that's still today one of those things that needs to be paid off first.
Mm-hmm. Oh, one other, gosh, I could have done 30 minutes just on credit myths. One other thing that people mistakenly think is paying off a collection account. You can pay off a collection account and have a zero balance still reporting on your credit. And those collection companies report every single month to those credit reporting agencies, zero balance, zero payment, zero balance, zero payment. Every single time they report to the credit bureaus, it is showing activity on those collection accounts and it is having a negative impact on your credit score. So if you pay off a collection account, you have to go through the steps of having that creditor delete the collections from your credit score. The conversation I had with this gentleman over the weekend, he's like, because he had several collections that showed a zero balance. And he's like, but I paid them off. Yes. And that shows that until you ask, and it has to be done in writing, until you have those collection accounts deleted by the creditor, they will continue to report and have a negative impact on your credit score.
Without going down a rabbit hole, what if you have like 12 mortgages, rental properties or something?
Depending on the type of loan, it may impact the debt to income ratio. But if you're looking at buying a personal residence and you have a dozen different rental properties, those show up and you've got mortgages on all of those. Hopefully you've got a positive payment history, which is helping with your credit score. And then from a debt to income ratio standpoint, we're going to be looking for tax returns that show how much money you're making on rental income. We're going to be looking for leases, and we're able to use that positive income to offset that debt. Or if you are buying another investment property, then you do a DSCR loan where we're looking at your credit score, but we're not looking at your debt to income ratio. You are very welcome. It was a pleasure being with you all. If there's anything I can do to help you in the upcoming week, don't hesitate to reach out, and I will save Daniel the editing trouble. There's all my contact information.